All right, let's talk about two things that feel like they're from completely different planets: oil and Bitcoin. One of them powers our cars, right? The other is supposed to be powering a digital revolution. You really wouldn't think they have anything in common. But in the weird world of finance, it turns out they're locked in this really surprising dance. So today, we're going to break down that hidden connection. I mean, just think about it. One is this physical commodity that we literally drill out of the earth. The other, it only exists as code. So why on earth do their prices sometimes look like they're following each other? That's the puzzle we're going to unpack. So, which is it? Is there a strong link or is it a weak one? I mean, look at this. The research is completely all over the place. To get to the real answer, we've got to start by dismantling a pretty common myth. The simplest explanation, the one everyone kind of jumps to, would be a direct link, right? When oil goes up, Bitcoin goes up. It's a really neat idea, but the data? Well, it tells a very, very different story. Now, I know these charts might look a little complicated, but the story they tell is actually super simple. They're just measuring how closely oil and Bitcoin prices move together. And if they were really linked, you'd expect to see these tall, consistent bars. But instead, they're all over the place. They're tiny, they hover right around zero, and that tells us one thing loud and clear. There is no consistent direct connection here. I love how one study puts it. It just says they are not always in the same boat. And that's perfect. They might look like they're sailing together for a little while, but ultimately they are driven by totally different currents. So if a simple price-for-price connection isn't the whole story, what is going on? Well, the real link is indirect. It lies much deeper, and it's driven by these massive economic forces that actually connect them both. It's way more interesting. Okay, so the connection isn't a straight line. It's a chain reaction. The best way to think of it is like a series of dominoes. A big change in the price of oil tips over the first one, setting off this ripple effect that goes across the entire global economy. And eventually, it reaches Bitcoin. And here is that chain reaction laid out in 4 simple steps. First, you get a major shock to oil prices. That sends inflation fears just ripping through the economy. That, in turn, forces central banks to step in and do something, to adjust their policies, which then dramatically impacts the flow of money, liquidity, all around the world. So, the absolute crucial point is the central bank's response. See, to fight that inflation that was kicked off by oil, they make money more expensive by jacking up interest rates. This is their main weapon for cooling down the economy, and it has this huge knock-on effect for assets like Bitcoin. And this is where Bitcoin finally enters the picture. Its price isn't directly tied to oil, but it is tied to the economic fallout that started all the way back with that big oil price shock. You should think of Bitcoin as a high beta or risk-on asset. It's a bit of jargon, but all it really means is that when there's a lot of easy money flowing through the markets and investors are feeling bold, Bitcoin tends to do really, really well. But when things get tight, it's one of the first assets to feel the pain. So here it is, the final link in the chain. An oil shock leads to central banks tightening the money supply. This dries up all that easy money, it makes investors super nervous, and that puts intense selling pressure on those riskier, high beta assets like Bitcoin. So the key insight here, the thing you really need to take away, is that the relationship between oil and Bitcoin isn't fixed. It's not one thing. It all depends on the broader economic context, or what we can call the regime. So there are really 2 key scenarios to understand. Okay, first, you've got inflation, but money is still cheap and easy to get. In that world, Bitcoin can act as a hedge, and it benefits from all that extra cash sloshing around. But when central banks start fighting that inflation by tightening policy, Bitcoin's story completely flips. It becomes this vulnerable asset that tends to sell off. And all of this brings us to a really crucial question. As Bitcoin becomes more and more a part of the traditional financial system, does it actually lose the very thing that made it so revolutionary in the first place? Its independence? You have to wonder, the more it's tied to the old system, the less it may be able to escape its rules.